Hello, welcome back guys. In this video we are taking a look at a request that I had from one of our subscribers for a company that I wanted to actually review myself as well. It's Context Logic, or as it's mostly known, Wiz.com. And obviously a lot of people are potentially interested in this one, a very well known portal, basically an e-commerce company that has been doing greatly in the past. Like at some point you can see here the stock was doing fantastically. Like this is a 2021 I believe IPO. Let me actually find it out exactly here. In our company profile page you can see the exact time that the company had its IPO, and it was actually December 16, 2020 when it had its IPO date. Now, let's go back and take a little bit of a look and actually understand what is going on here with context logic and whether it's an opportunity to potentially add to a portfolio or whether we should stay away from a company of this sort. Again, a lot of people are interested. Now, if you take a look at the 3-year chart as I did earlier, which is basically the whole the whole operation of the company since it went IPO, and you will see that it has been dropping and dropping and dropping. And since its 1-year high, it used to be like $2, 2.5, it's down 75% almost. But since its all-time high, it's actually closer to 99% down. It's insane how low it has been going and pretty much continuing low. Now, in the 3-month chart, you can kind of see that it had a little bit of a spike along with the rest of the stock market, I suppose. Now it's going down a little bit. Yesterday, it had a very down day. Again, with the rest of the stock market, obviously, this is going to be affected. But what we need to understand is what is this company doing financially? Is there a potential for a workaround? Now, before we examine the financials, I wanted to take a little bit of a closer look at this article, which was written a few days ago, like 4 days ago, and talks a little bit about some interesting points that I wanted to mention about Wiz.com here. And it actually has a very nice breakdown here. Now, cost cutting is significantly impacting revenues. Through the first 9 months of 2022, revenues are down an astonishing 75% from the prior year, which is a big problem. So the most recent quarters, the company's revenues have been going down. Now, this is understandable based on what has been happening in the previous, obviously, months and quarters. We had the pandemic, we had the lockdowns, a lot of companies were affected. But remember, this is not a company that is holding cash. It's not like Amazon, for instance, that can actually take it easily. This is a company that is a much smaller company, and they do have to eventually become profitable and keep making money. Otherwise, they can potentially even go bankrupt. So this is important to understand. Macro headwinds still lie ahead in 2023. Many e-commerce giants such as Amazon issued cautionary warnings around slowing demand. Another problem here. This company, remember, is a .com company and even has it in its name, Wiz.com pretty much, and kind of brings some memories about the .com era, and it kind of behaves a similar way. Now, this doesn't necessarily mean that it's going to go bankrupt, but we need to be very aware about what the company is doing financially before taking the plans here, if we are interested in potentially investing in this one. And it's also a consumer discretionary stock. Obviously, the kind of business that Wiz.com is doing, is not a business that is non-discretionary, meaning that it's not like selling food and things that people require for survival. And so these kinds of items that are discretionary, for instance, cars are discretionary items. People want, but they don't really need to survive, is the thing. You do need clothes to survive, you do need food to survive, you do need medicine. These are the non-discretionary items. Now, cash burn is still very high, and of course is a very high, big concern here. Shareholder dilution, we're going to talk about it, has been happening for a while now and seems to be continuing at the moment as well. Revenue sources are changing. During Q3, logistics revenue outpaced core marketplace revenue. And competition remains fierce, and this is another big problem here, especially from the likes of Amazon, Walmart, Target. All these companies basically have similar businesses here, and there is, of course, they're even much more scalable, obviously, but they can pose some threat here to Wiz.com, to Context Logic, pretty much. And as you'll see, the company stock price has plummeted since going public a few years ago. Okay, so let's take a little bit of a look here at the financials. What is going on with the financials of the company? Now, we are starting with a P ratio that is negative and a price to free cash flow that is also negative. And obviously, we don't like to see those. We definitely want these values to be positive and low if possible. This indicates that the company has been losing money, and we are going to examine exactly how much the company has been losing. Now, a company that is losing money is not necessarily a bad investment, but there is a much higher risk for it to potentially be a bad investment. So when you take the plunge and you actually buy these kinds of companies, you need to be super aware that you are getting into risky territory, regardless of how good you think a company of this sort can be in the future. There's still a lot of risk when we're buying this one today based on the current financials. Now, we could potentially get rewarded, but this can be sort of like a casino bet in some situations, because most companies that are actually negative, that are not making money, will keep not making money and eventually even go bankrupt. It's not the norm that you get a company that is losing money to eventually make tons of money. That's not the norm. These are outliers for the most part. And people are looking at companies like Amazon or Tesla that were losing money for many years and eventually started making money, and tons of money, for instance, Amazon. And they are like, okay, Wish.com is going to be the same, or I don't know, DocuSign is going to be the same, whatever. But this doesn't work like this. Some companies could make it, yes, for sure. But between these companies that make it, there are going to be so many other ones that are going to go bankrupt or keep pretty much not doing well over the years, so that you have to be super, super careful not overdoing it with these kinds of companies. Unless you are willing to potentially take a high risk for a high potential reward. Now, outstanding shares, take a look at this one. The company has been printing shares, issuing shares like crazy because they have to fund themselves somehow. And the only way to fund yourself as a company, themselves as a company, is basically two ways. You either issue shares, which you give away to shareholders for a price, for the current price, or the other way is to actually get debt, which is even more problematic because then you have to pay interest. At least issuing shares, you don't really have to pay anything on top of that. The total liabilities of the company, obviously in the negative because the company doesn't have really free cash flow, it's in the negative. Now, the revenue of the company has been growing, although it has been going down in the most recent quarters, even worse, frankly. This is the fiscal year over here, but still going down. And the net income growth is exactly what we don't want to see. It has been declining, and the same thing with the free cash flow. And it's only the total equity growth, but remember, total equity grows as you are selling shares. And so as the company is issuing stock, they're getting money out of this stock. This is assets for the company, basically, this extra money that's coming in their coffers. But it's diluting shareholders massively. And so this, while it's green, it's a bad thing because of the way it gets generated. It's not coming from profit is the problem, really. And of course, a lot of the returns here are going to be negative because the company doesn't really have any returns. The margins are negative and all that. And also the company doesn't have debt, which is a good thing. They don't have debt, and that's because obviously they are issuing shares in terms of instead of getting debt. Now, eventually, there will potentially come a point where they may actually want to take some debt instead of continuing to issue shares. Because, when you issue shares, obviously it's going to be tougher to get the new shareholders if this becomes the norm. And also you are massively diluting and dropping the stock price eventually. And so, this is problematic, and it's really, really bad for shareholders. You cannot really keep doing it forever. No. Now, let's take a little bit of a look at the financial statements, just to take a little bit of a closer look at what the company has been achieving in terms of numbers, from like 1 billion to 2 billion. This is not even too much. There is some good growth, obviously. This is 5 years, but this is not tremendous growth. And if you take a look at the quarterly, you can see what we talked about earlier. This has been plunging over here, so dropping and dropping and dropping, the things that we saw in the article, basically. So the most recent quarters have been even worse for the company. Again, this can kind of be expected based on what has been happening in the economy in the past couple of years. So this is not really a huge problem as long as the company goes back to what they were previously doing. But what they were previously doing, was it good enough? Like, if we take a look at the previous years, what was going on over here? So the net income was still negative. And yeah, it became a little bit more negative over here, but it was still negative and solidly negative. Now, 2019 seems to be the best year over here, but then again, we had the situationship with COVID and everything. And so, yeah, this kind of went into even more negative territory here. Now, the balance sheet, again, what we talked about earlier, you will notice that the total equity is positive, and that's happening because of the issued shares, which is additional paid in capital. The capital that is paid from the new shareholders, basically, that are grabbing the shares that the company issues. So this is why it's positive. And the net income, again, remember it was negative, which translates to negative operating cash flow, as you would expect. Of course, after some of the adjustments, it's still firmly negative here. And if you take it to free cash flow, after some of the capital expenditures are accounted for, which are very little, this is a software company, basically, it's like an e-commerce platform. And so the free cash flow here is still in very, very negative territory, like losing $1 billion over here, for instance, in the most recent quarter. So not great here for context logic, which is going the wrong way. Now, a lot of people could potentially be looking at this chart, let me go back here, and be like, okay, this has been going down and down and down, it's less than $1, and how low can it go? Like, we're less than $1, right? So there's only the stock going up from here, right? But that's not the case, and this is a thing that a lot of investors are actually thinking potentially about stocks that have been plunging for a while, and they started at like $30, $50, whatever, and then they started dropping and dropping and dropping. They went sub $1, for instance, at like 50 cents, for example, and they were like, okay, that's time to buy, right? I mean, how lower can it go? But there is a very, very big issue thinking like that. And I know a lot of people do it again because of like technicals and technical trading and all that. You're waiting for some resistance levels and support levels to get fulfilled and all that. But it's very, very important to understand that if the company doesn't get better financials, doesn't actually make more money and actually sustain some of that money and not really be in the negative every year, the thing that you are going to see more than likely is the company having a reverse split. Now, companies have splits when the stock price is very high usually, and they want to kind of take it lower so that it becomes a psychological barrier. If it's very high, it's a psychological barrier for investors. So they kind of drop it by splitting shares. Now, companies can also do the reverse thing, a reverse split, which means that they're getting this amount of shares over here, like the 673 million, and they divide it by like 10. So one of like 10 shares become one. And so this becomes basically multiplied by 10. It's going to be like $67, for example. Now, so you multiply it, and you are basically dividing the amount of shares by 10, by a factor of 20, 10, whatever. Now, why would a company do that? There is a reason. When the stock price drops below $1, companies get a notice that they have to actually increase the stock price because otherwise they're going to be delisted. And you cannot have a stock that is like below $1 for a long time trading in the stock market unless it's like OTC, it's like delisted, it's over the counter. And so at some point eventually, if this continues, which looks like it's the case, they will have to reverse split. And when this happens, typically the stock goes down even more. So I would caution people that are actually potentially interested in buying this one to maybe even wait a little while to buy it, potentially, if they really want to buy it after the reverse split. Now, should they buy it? We will take a little bit of a look at the stock evaluation tool. Our discounted cash flow model can tell us a few things. Now, the company has been losing money. It's a problem. Like, how do you value a company that has been losing money? It's tough. And you need to be taking some risks if you buy it. Regardless of what we see here, it's going to be risky. Now, the revenue growth that the company has been achieving, it hasn't been tremendous. It has been good in some years, subpar in others, but still, okay, we can say that the company could grow with a rate of like 10%, 15%, and maybe 20%. That's going to be our high projection. This is obviously fairly aggressive here, but it could happen. Now, the net income margins is a problem. The company has been losing money, so these are negative every year. So what are you going to do here? If you put negative numbers, this model doesn't even make sense. A company that never makes money is not worth anything, period. You have to have a company that at least eventually makes money in order to account for potentially buying it today. And so what we're going to do is assume that the company is going to have some marginal net income here. So they are making a little bit of money. How much? Like, let's just say 1%, 3%, and 5%, three cases. And they sustain, let's just say 100%. So I'm going to use 100% here, basically saying that the free cash flow margin, when you compare it to revenue, is going to be 1%, the same as the net income margin. And this is going to be 3%, and this is going to be 5%. Basically 100% of this value is how this works. And so this is the same, basically. Its net income becomes, its amount of net income becomes free cash flow. Now, again, these are some scenarios. Here we are just trying to figure out what the company could potentially do if they become profitable, marginally that is. And an annual return of 13% is what we're going to be asking for. It's very typical. and I hit calculate. Let's see what kind of price it potentially makes sense to pay for this one. Now, you will see that the low one is 63 cents, and the stock price right now is 67. The medium one is 2.3, and the high one is 4.6. Again, with these kinds of projections here, these projections are aggressive, very aggressive. The company is not making money right now. And this is what I wanted to really caution you about. If you are entering this one, there is a high likelihood that it could potentially even go bankrupt. You have to acknowledge that. Now, if you are willing to acknowledge that and you want to take some risk, potentially, maybe for some higher rewards in the future, buying a little bit may not be completely out of the question. Like, it may not be a horrible idea. But again, you have to acknowledge and you have to see that the financials of the company have been getting worse and worse, deteriorating. And so it's very possible that this company could eventually go bankrupt in the future. Now, it may take a while because the company doesn't have a lot of debt right now. And typically, companies that have a lot of debt are the ones that go under. But if this kind of situation continues, when they're not really making money and they have to keep issuing shares to fund themselves, they will eventually have to get some debt. And if this starts accumulating and they do not make money, then they could very easily go bankrupt. Now, if they manage to turn things around, though, then you could have some insane upside. Like, you could potentially see the company stock price skyrocketing from here. So that's what I wanted to tell you about Context Logic. I think they're having their earnings report tomorrow, so we'll see what's going to happen then. But high risk, high reward is what you need to be remembering here. And I hope you enjoyed this video. If you did like it, please leave a like and subscribe. Remember, you can get everything that I showed you here in R2. This is available for our Patreons. And the links are in the description box below this video. If you're interested in joining, you can have access to everything that I showed again. And leave a comment below. Tell me what you think about Context Logic. I'm interested to hear your opinion. Interested in hearing your opinion about this one. It's one that is, it's tough to say. It could eventually be an interesting bet, but again, super risky as it is right now. Thank you for watching, guys. In the meantime, take a look at this video that I made earlier. I'm talking about Charlie Munger and what happened there with Alibaba. I think it's a very interesting video to take a look at. And thank you for watching again. See you soon. Bye.